How's it going, everyone? Today, let's go ahead and talk about Humana. This is a dividend compounder with cheese that is on quite the dip these days. It is hovering around its 52-week low of $299 a share, so it may or may not be a good time to jump in. And if you zoom out and look at its 5-year history, right now at its current trading price of $312 a share, it's around the same price that it was back in 2019. So in this video, we are going to look at the intangibles, the finances, and run some valuation models to figure out if it's a delicious or a disgusting dividend stock. A stock that is neither will be labeled as decent, but I don't think Humana is going to be decent. But let's go ahead and find out. I am not shy about my opinions. I don't like Altria, yet I invest in the tobacco company. I don't like the health insurance industry, yet I think on paper they are amazing businesses. Humana is typically known as a health insurance company to most people, but they are much more than that. Humana actually has millions of customers under their umbrella paying a subscription like Spotify or Netflix every single time period. Their business model is not going to slow down anytime soon because they are a cash generating machine that is profitable. And to make a profit, insurance companies will make sure the premiums what you pay every time period are greater than any future claims, which is known as underwriting the profit. They have whole departments and teams full of people who will calculate the financial numbers to see if it makes sense insuring someone. It's a business at the end of the day, and they will make the premiums more than the surgeries and treatment costs needed, if that makes sense. Except in this case, the premiums are paid by the taxpayers. More on that here in a little bit. So what about their last earnings report? They posted their Q4 2023 results back in January, and it was nothing short of disgusting. They posted a $541 million loss because of increased Medicare Advantage costs and more people seeking treatments than they had anticipated, which means their actuaries did not do their jobs properly of underwriting the profit. On the flip side, they did post $26.6 billion in revenue, which is absolutely crazy for a health insurance company. And looking forward to the rest of this year, they posted a gloomy and scary guidance for Wall Street. They expect their earnings per share to be in the range of $16 a share, whereas their previous forecast was $29 a share. I am not going to lie, that is pretty bad. And as of recently, Humana was hit with more bad news as the US government said Medicare Advantage plans will only receive a funding increase of 3.7%. And let me tell you, Wall Street wanted to see a bigger number. So very recently, Humana just went through a really massive sell-off. And needless to say, Humana definitely will have a rough year or so until they are in the clear again. So when you think of Humana, it is very sensitive to which political party has the influence and power in Congress, as a majority, if not all of their revenue will come from the government. And the government can decide how much spending they want to allocate to healthcare. Medicare, if you don't know, is health insurance to our most vulnerable population. But the idea here is that more and more Americans are getting older, right? Which means the market share for Medicare spending has to match the population increase in the senior category. And here's the thing, we as humans are no longer expecting life to end at 65 or even 68, which means we need Medicare longer than we have in the past. The growing older population that lives longer is the bull case for Humana. And it doesn't matter if you're a Democrat or a Republican. Everybody can agree that our elderly parents and grandparents need Medicare. What else is new with Humana? Well, as of this year, they are ending their commercial insurance business. Going forward, they only want to focus on insurance that is government funded, kind of like Lockheed Martin or Raytheon. They only like those government contracts. Humana will only offer Medicare Advantage plans and be the health insurance provider for TRICARE East, which if you don't know anything about TRICARE, it takes care of our US military members that live in the eastern half of the US. And on a business level, I can understand why they're doing this because old people and military folks are their most profitable divisions. Their commercial division only made up 4% of their revenue. So I can see why they cut ties and let that go. So besides Medicare and TRICARE, they do have other offerings such as Medicaid, CenterWell, which is their primary care business for senior citizens, and they also operate a pharmacy through their CenterWell business. So those senior citizens that are seeking care at CenterWell are also filling their prescriptions at CenterWell. So as you can see, Humana has created a little monopoly here. It's a pretty diversified healthcare business to say the least. And here's a fun fact about Humana. Humana had a failed merger with Aetna back in 2017. Aetna is CVS's health insurance line of business. And the reason that it failed was because of antitrust issues. Then just this past year, Cigna, which is another major health insurance player, and Humana tried to merge, but they also called it off. Cigna decided to use their money instead to do an additional $10 billion worth of share buybacks. So the big healthcare giants want to buy Humana. Just think about it. Would they really want to buy a company that is trash and worthless? In business, you typically want to acquire companies that you see as a competitive threat or that have an advantage over you. If you didn't know, well, now you know. The only real threat I can feel with Humana is their dependence on Medicare being government funded. Some people think Medicare will go bankrupt by 2030. The same story with Social Security. If that's the case, what happens to all the elderly people in the US needing medical treatment? I genuinely don't think Medicare is going to disappear. However, in the next 5 years or so, I think there will be legislative changes. That part I know for sure because the system right now is absolutely broken. So their threat is the lawmakers, and what you see on your screen is their financial numbers. From 2019 to 2023, just look at their revenue increase, and that's not in millions. This is billions of dollars. $64 billion in revenue in 2019 to now $106 billion in 2023. I'm not gonna lie, it's looking pretty hot. So back in 2015, they paid $1.15 a share in dividends. However, in 2024, they are now paying out $3.54 a share, which means that their average dividend growth rate is sitting at 12%. I know, when you look at their dividend yield being just above 1%, you're probably like, yo, that is way too low. I am not interested. But when you think about how their dividend is growing at a rate of 12%, you gotta think long term, my friend. And not only that, their dividend payout ratio is under 20%. It's literally 17%, which means there's a lot more room for them to increase the dividend payout. And the cherry on top is that they have been increasing their dividend payout for the past 7 years. Humana's total return. So if you had invested $10,000 in January of 2014 and you fast forward to March of 2024, your $10,000 would have grown to $36,000, which I think is pretty remarkable. That spits out a CAGR of 13% year over year, meaning your money grew that much every single year. And during their best year, Humana's stock price went up by 40% back in 2014. And in their worst year, which is this year, their stock went down by negative 24%. I'm telling you, they are on a dip right now. And whether or not you agree or you think their sell-off is justified is up to you. But the matter of the fact is, $10,000 to $36,000 as your total returns if you had reinvested the dividend payouts back into this investment. So the next metric we are going to be looking at is the shares outstanding. Essentially, we want to figure out if the company is diluting the shareholders or if they're buying back shares. If there's less shares outstanding, that is a good thing. So if we look at their history, back in 2009, there was about 169 million shares outstanding, right? But if you look at this graph, you can see that the leadership and the board of directors have made the deliberate decision to buy back the shares almost every single year. And as of today, there's roughly 124 million shares outstanding. It sounds a lot better than 169. Now let's go ahead and look at some numbers. First up is going to be the revenue. Investors call this the top line. So back in 2015, this health insurance conglomerate posted $54 billion in revenue. My goodness gracious. And as I look at the subsequent years, it does look like Humana has been growing their revenue at a very aggressive rate, except for 2017 when it went down by negative 1%. But if you zoom out and look at it from a bird's eye view, from 2015 of posting $54 billion to last year of $106 billion, nothing short of amazing. Next, we're going to be looking at the bottom line, which is the net income. Now, unfortunately, unlike the revenue, I would say the net income is all over the place. Sometimes it goes up by triple digits, and other times it goes down by double digits. So this one for me, I wouldn't say is a red flag, it's just Ideally, you want to see it in the same trend of going up, but to see it go up and down throughout the years is just kind of Next, we are going to look at the technical indicators to figure out what the stock price movement has to say about the company. So based on their trading pattern, we can conclude that Humana is going through a massive sell-off, and I'm making that conclusion based on their RSI right now hovering at around 20 to about 30, whereas their historic RSI has been around 60 to maybe even 70. And not only that, when you look at their Bollinger Band, it looks like Humana does have the potential to drop down to $297 a share in the near future. But keep in mind, technical indicators are super subjective, so we'll just go ahead and see what actually happens. Alrighty, now we have made it to my most favorite part of the video, which is running some valuation models to figure out the intrinsic value.
Well, intrinsic value, in other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
And once we do that, we're going to compare it to what the Wall Street analysts believe the price target should be. And then after doing all of that, I'm going to try to figure out an acceptable buy price. So the first intrinsic valuation model is going to be the multiples valuation. Essentially, we're going to figure out an intrinsic value based on how the market prices their competitive peers in the same industry as Humana. So every single one of these companies are in the insurance space. The median PE ratio is 18.4. So based on their earnings per share of $20 and the median PE ratio, this is going to give us a stock price of $368.15 for Humana. Moving right along is going to be the discounted cash flow analysis model. Basically, the free cash flow and the growth thereof is going to tell us the intrinsic value for Humana. Now, when we look at their free cash flow, it is all over the place, just like their net income. Like back in 2019, they posted $4.5 billion, which was an increase of 191% from the year prior. But then as you fast forward 1 year during the pandemic, it only went up by 2.7%. And then the following year, it went down by negative 79%. And then it went back up by triple digits. I'll be honest, this is looking pretty wonky, but it does spit out an average growth rate of 74.5%. However, that is way too optimistic, and the numbers are a little unreliable. So instead, we're going to go ahead and trust what the Wall Street analysts believe the growth rate should be and plug in 8%. So we're plugging in 8% when realistically it's 74%. So please be cognizant that we are being conservative and playing it safe. Now, if we take that number into consideration with some balance sheet numbers, this is going to give us a DCF price for Humana, $692.06. $692. My goodness. Let's go ahead and move on to the next intrinsic valuation model. This one is going to be the DDM. Essentially, the dividend and the dividend growth rate is going to tell us how much Humana should be worth. Now, when we look at 2019, they paid out $2.20 a share. And as you fast forward to the present tense, now we're looking at receiving about $3.54 a share. The average dividend growth rate, when we take into consideration the past 5 years, is 12.6%. However, once again, that is a little too optimistic for my taste, so we're going to shave that down and plug in 7.25% instead. So we're making the assumption that worst case scenario, Humana is going to grow their dividend payout by 7.25% going forward. The intrinsic value for their DDM is $506.22. And the last intrinsic model is going to be the Benny Graham's valuation model. This one never lets me down in giving me the lowest price. And basically, we're going to be plugging in the growth rate projection, which is 10.3, into the formula alongside with the current AAA corporate bonds yield rate of 5.1%. So the Graham's valuation for Humana is going to be $298.68, which brings us to the conclusion. Hey, Jimmy, I need you to wake up because you need to do the drum roll, man. So the intrinsic value for Humana is what do you think it's going to be? It's going to be $466.28 a share. Now let's go ahead and see what the Wall Street analysts believe the price target should be. So Wall Street believes that Humana should be priced at about $461 a share, with a high estimation of $630 a share, and somebody is Mr. Bear because he thinks Humana is only worth $310 a share. So we said Humana is $466. Wall Street says $461. A $5 discrepancy is not too bad. So after seeing and hearing and researching everything, I want to figure out what an acceptable buy price would be. So depending on the day, Humana is going to trade somewhere between like $305 up to like $320. But right now, as I am making this video, they are currently trading for about $312. So plugging that in and baking in a 5% margin of safety.
We don't think we need a huge margin of safety because we don't think we're going to be wrong about our assumptions in any material way. When we see a great business, it's like if you see somebody walk in the door and you don't know whether they weigh 300 pounds or 325 pounds, you still know they're fat, right? And so if we see something where we know it's fat financially, we don't worry about being precise, and if we can come in that particular example at the equivalent of 270 pounds, we'll feel good.
Then my acceptable buy price is $442 a share, which is a discount of $130 a share. But let's go ahead and plug in a number like, I don't know, let's say 15%. With a 15% margin of safety, then the acceptable buy price becomes $396 a share, which means that you get a discount of $84 with 15% baked in. But let's go even bigger, right? Let's plug in something like 30%. With a 30% margin of safety, then the acceptable buy price becomes $326 a share. Now, if I were to buy Humana at its current trading price of $312, then the margin of safety that I get is 33% based on its intrinsic value. So, what is my opinion? And before I ruffle up some feathers, here is where I am coming from. I absolutely despise the health insurance industry. I think it's crooked, and I don't think they should be making that much profit off of medical costs that people need to survive from cancer treatments and whatnot. Yet, as an investor, I separate my personal feelings from solid, high-performing businesses. And because of that, I am keeping a close eye on United Health and on Humana. To me, it's like comparing Visa to MasterCard. They're both really good at what they do. They have double-digit growth numbers, and they have an economic moat. And my thought process is, why would I invest and buy into Visa when they're near their 52-week high and they're kind of overvalued, right? On the flip side, Humana is trading near a historically low price, and I absolutely love getting a good deal. I remember a week ago when their stock price dipped to $302 a share, I was sitting on the couch in disbelief. Minutes later, it dropped to $299 a share, but I did not pull the trigger because I didn't do my intrinsic calculation, even though my emotional brain was telling me to buy the freaking company. However, after doing this research and looking at the numbers, here's what I'm going to say. I will probably jump into Humana next time it dips below $300 a share. And if it doesn't, if it flirts around $305 to maybe $306 a share, I'll probably buy in. It's a dividend compounder with cheese, just like I said in the intro. But I'm also really liking the sell-off on United Health. So at the start of the new year, United Health was trading for roughly $545 a share. Since then, they have been on a massive sell-off, and now they're currently trading for about $439. So when I look at United Health, I'm like, whoa, that actually looks pretty attractive. She's looking pretty cute. So I think it's really going to depend on my mood on the day I decide to buy one or the other. With that said, please, I am begging you, do your own due diligence and research to figure out if Humana is delicious to you. Because to me, I think it's absolutely delicious. It's underrated underrated, undervalued, oversold, and at a historically low price for a company that is just operating on solid fundamentals. Yes, they have a temporary setback for this year and maybe next year, but going forward, I think Humana is going to be okay. It's a wonderful business that I would love to be an owner of. So with that said, Dividend Compounders with Cheese signing out. Stay safe, everyone.